All right, good evening, class. Hope everybody's having a good day. We're near the end. We're right there. Real estate finance, first class. You only got 2 more days left. Okay. Yeah, so we only got 2 days left, and I am just as excited as y'all. That's for dang sure. I'm ready to be done with this. Um, so today we'll be talking about processing real estate loans. So kind of um, we'll just talk the very basics of going in for a loan, applying for it. We'll talk more about the qualifications for these loans, and then kind of the process within the bank that they go through all the way up until closing. So this right here is it's a little depiction of kind of who you'll deal with as a real estate agent in the loan process. The loan officer, now that's the person that you will directly deal with. All of your correspondences will be with the loan officer. Like I said the other day, I've never really had to talk with the processor at all. Never really had to. You don't deal with the underwriter because you don't want to. They they are the ones who go through the qualifications of the loan, so you don't want to have any correspondence or talking with them trying to make it look like you might be bribing them to try to get your clients a better deal. So you won't talk with the underwriters at all, but you will talk with the closing officer quite a bit. So the loan officer itself, and then the closing officer, those are the people that you'll have contact and communications with, and the closing officer is kind of deal by deal. The loan officer is when I say like you want to have a good relationship with your lender, I'm talking about the loan officer. Those are the people. I don't think I've really talked to him about him a whole lot in this class, but our office has a guy named Jake. He doesn't even work out of College Station. I think he works out of Hempstead. But he's, you can call him at any time in this office. I can call him at any time. Hey, I got people, blah blah blah. I'm trying to get a loan, and then he'll kind of pretty much drop whatever he's doing and help us out. Justin's really close with him, and there's been times where I've been with Justin on a Saturday. I just had a couple of questions about like the process, and this was at the beginning of me being an agent. So, and I brought up a couple of questions to him. He didn't know it was a Saturday afternoon. It was probably around 3 or 4 in the afternoon, and he was like, "Well, shoot, let's just call Jake and ask him real quick." Jake was, I don't know what he was doing, but he was hanging out with his kids. Once he got the call, he was like, "Yeah, hold on, he got his wife in there. She started watching the kids real quick. He hopped on his computer, answered the questions, and then got back to doing whatever he was doing." So the loan officer is the person that when we talk about you want to be friends with your lender, that's the loan officer. The closing officer, those are the people that once they've secured the loan and you're like kind of going through the transaction process, the closing officer is who you'll deal with mainly after that. And this is just making sure everything you'll talk with them every 2 to 3 days, just making sure everything's going well throughout the transaction. There hasn't been any hiccups anywhere. Yeah. So the loan officer and the closing officer, those are who you'll talk to. The processor and the underwriter, those are the people who do the dirty work on the loan and make sure that your clients do qualify. And I've heard instances where you need all 4 of these people to be in the loop with each other to get this loan done. I've heard of instances from Justin where the loan officer, the processor, and the closing agent were all working, but the underwriter, who was actually supposed to be looking at the loan, had no idea that there was a loan. So, and they found that out a few days before closing. Didn't make the deal fall through, but they had to push closing out about a week. And when you're looking forward to a nice check, and your clients are looking forward to getting into a house or selling their house, pushing it out a week when you think you're coming up on it is not what you want to do. So try to keep everyone, when you are talking to the loan officer or the closing officer, just make sure how's the processing going, how's the underwriting process going, Is it all going smoothly? You just want to check on all facets and make sure that they are running smoothly. Because yeah, if you lose one of these, any of these four, you're going to lose the loan. So yeah, you want to stay on top of that as much as possible. Now qualifying the borrower, talking about loan application. Again, like I've said probably 40 times throughout this class, when applying for a loan, your employment and your income is going to be very big. Some of the big qualifying factors, making sure you you do work at the place you work at and the income that you make is true. And that kind of gets down to these other bullet points. Talking about assets and liabilities, obviously the lenders will go through your assets and liabilities, to make sure, looking at collateral for the loan, making sure you have enough, any kind of, nice cars, any kind of expensive, like very nice jewelry can be put up as collateral. A lot of people don't know that, but if you have, I wouldn't recommend it for putting your wife's wedding ring up for collateral. You can do all that kind of thing. So they do want to make sure, that your assets are over your liabilities. They don't want to be giving a loan out to somebody who's starting out negative. That's for sure. So they will check those assets and liabilities. Verification of deposit and verification of employment. Like I said earlier, they're gonna, when applying for a loan, they're gonna check your bank account. They're gonna check. They're gonna call your employer. They're gonna have a conversation with them, making sure that you do make the amount that you make. And typically, this is an easy process. Kind of where they run into trouble with this is if you work for the government at any level. Really, at the local level, it's not too hard. If somebody's works at the county clerk's office or whatever, something on the smaller governmental level, it's going to be pretty easy. You can get in contact with HR of towns pretty quick. It's kind of when you get up to the state and federal level. If you get up to the state and federal level, obviously y'all been to the DMV, y'all dealt with getting tickets and that kind of thing. They don't like to work fast. They don't like to get back to you on their time. They get back to you on their time, not on yours. So, if you have a client that works for the government, especially at the state and federal level, you're going to want to be in good talks with with your loan officer, making sure that they've already checked for employment and all that kind of stuff, because it can take multiple days to weeks for them to actually get back to them. So you're going to want to keep up with that. And then talking about more of the verification. They're not just going to take their word for it. They're going to call and check, make sure everything checks out correctly. And then, like I've said many times over, credit report and your credit score is also a very large, goes into the application process, as y'all already know. And the underwriter, they're not only going to look at these at your whole application themselves, and then decide whether or not you qualify for the loan. They're going to throw it into one of these electronic underwriting softwares as well, whether they use desktop or loan prospector. These are really the two things that decide whether or not you get that loan. So underwriters do a lot of work. They do stay busy somehow, but these two applications pretty much do the majority of their work. So I really don't know what they do. Maybe I need to go be an underwriter. Credit scoring. We have it broken up into a nice little pie chart here. It obviously doesn't equal. This is just some clip art. It doesn't equal these percentages over here. Why would you think your payment history is a 35% going into your credit scoring? Why is your payment history 35%? Why is this the biggest portion, the biggest factor that goes into you qualifying for a loan or for your credit score? Why would you think?
They just want to know how good your payment history is. They, your habits are. Pay back quick enough. Isn't it the quicker you pay, the better you?
Yeah, well, yeah, exactly. They're going to check and make sure you just paid on time.
Yeah.
And you don't have to necessarily be paying back quick. Obviously, it is a good thing to pay back quick, but yeah, they just want to make sure that you do pay back, anything that you have credit on or you've taken out on credit. They just want to make sure that you pay on time. That's why it's at 35% there. And then your amount owed right there, 30. That's technically going to be your debt. And that kind of goes back to the assets and liabilities over here. They want to make sure that your assets, that your bank account, that your income is going to be able to offset the amount that you owe on, whether it be cars, other properties, credit cards, anything like that. They're gonna make sure. I mean, if you only make $200,000 a year, but you have $1 million in credit, you have $1 million in credit that you owe. You're probably not going to get that loan. So that's a really big part of it as well. Credit history. This is, these top two are obviously most important right here, 30 and 35%. That's 65% of what goes into your credit scoring. But credit history, this is just kind of more about, how you've treated your credit in the past. It takes, you would think it doesn't take a long time to get to an excellent score under their credit history ratings, but it takes 25 years of paying stuff on time, not taking out more than you are able to pay, that kind of thing, to get this credit history, this 15% up to excellent. At about 10 to 15 years of good credit, they'll put you at good, but it doesn't take until 25 years to get excellent and get 100%, the full 15% year. New credit, they're going to check and make sure if you're going to buy a house, they don't want to see. They're going to do like kind of a 2-year check and make sure you haven't pulled out more than 2 credit cards in those 2 previous years. If you pull out more than 2 credit cards, then this 10% is going to be dwindled down to basically 0. If your client has ever, I've pulled out 4 or 5 credit cards in the past year, it's going to be hard for them to qualify for a loan. This is only 10% of their what goes into their credit scoring, but it does play a big factor. And then other factors as well, 10%. There's all kinds of stuff that goes into your credit scoring, and we'll actually watch a video here in a second about credit scoring and how they kind of come up with those and how that relates to the loan process. Credit scoring here, the credit scoring range typically is from around 300 to 850. Obviously 300 being, terrible, down in the toilet credit, and then 850 is supreme. You'll run into clients. Just if you can give me your best guess, what do you think is the lowest credit score that somebody can have but still qualify for a loan that you would think? Just your best guess, between 300 and 850. What would y'all guess? Yeah, your lowest score that you can have but still qualify for a loan. 400?
Yeah.
Okay.
I would say 650.
650?
Yeah.
Okay. Gio, what do you think?
Yeah, like 450 maybe.
450? Okay, so the actual score is actually 580. If you have a 580 or above, you can get approved for a loan. Obviously, right now with COVID and what that's done to the economy, the effects it's had, it's going to be quite a bit higher than 580. Banks are pretty cautious right now to lend out any money. But yeah, typically on a normal during normal times, 580 is about the minimal score that you can have and still qualify for a loan. But talking about these credit scores, I've actually had a client, or what was a prospective client, and she was saying, yeah, my credit score is like 715 right now, but I really want to get it up into the 800s to before I pull out any money, like try to get a loan. I just want to get my credit score higher. But credit scores are kind of like it's kind of like grades in a class. Throughout college, if in 700 even and above is an A. So when banks look at that and they see anywhere between 7 to 850, you're going to be rated as having excellent credit score. So it's nothing, like I said, that situation where she was like, I have a 715, I really want to get it. I want to get it up quite a bit higher. You can tell your clients like, no, it's totally okay. 700 and plus is excellent credit rating. Now, if somebody comes in with a 695, then yeah, you might advise them, hey, you know what? Wait a few months, pay down your debts, pay everything on time. Try to get that as low as possible. Bump up that credit score. 5 points. It doesn't take much to do it. Payments, it takes a few months. But get up to the 700 range, you'll be rated excellent. You'll get a better interest rate. So that's something that you can definitely advise them with. With tighter qualifying standards, lenders are requiring higher scores, like I just said, especially right now with COVID. It's kind of hard to obtain loans right now. So it's not hard, but they are getting more stringent with their policies. So you need to be careful with that. And then you can always advise your clients to obtain a free credit report from Equifax, Experian, or TransUnion. Honestly, if you don't, even as a regular college student, in your 20s, whatever, you should be doing it. You should go to this site, this annual credit report site right here, and you should run a credit report at least once a year. The government, they allow you one free credit check per year, and it's pretty much recommended to anyone to do it. Even if you probably have good credit, you always want to check it once a year because you never know if your identity's been stolen. And that's one way. It'll pop up real quick that you think you have like around a 650 in that range, and then it turns out you're in the 420s. Well, why is that? And Justin had this problem when he was in college. He had signed up for some stuff, getting some gift cards and whatnot, just in the foyer of wherever he was going to school in that area, kind of like the MSc up at A&M, and he was signing up for stuff, signing up for credit cards, but getting $25 on top of it. Didn't use the credit cards. Well, somebody ended up getting his information, getting his social security card, or his social security number. And they took out about $100,000 in debt in his name, and he had no idea. So, you can only think about how crazy that phone call would be, or when you go and check your credit, that it's in the toilet and somebody's taking out $100,000, because it's pretty hard to, tell these credit score companies that $100,000 wasn't me, and I'm not paying any of that back. Because they don't just say, oh, okay, we'll just drop it from your. They're going to make you prove that you didn't pull out that $100,000. So I highly recommend. I do it. I pull an annual credit report, and I check it, make sure everything's okay. I don't do a lot with my credit card, but I like to check it and make sure. My identity hasn't been stolen, and somebody's not just running up hundreds of thousands of dollars in debt in my name.
You could also check it on Credit Karma. They don't charge you, and it doesn't give you any dings for checking it. You can check it however many times you want.
Really? You can check it as many times as you want?
Yep, and it's current too.
I did not know that.
Yeah.
So yeah, you can go to Credit Karma as well. So this annual credit report, you can only pull it once for free. But it will pull all 3 credit scores from the Equifax, Experian, and TransUnion. So, when you go to check your credit score, do you think if you were to go to Equifax, Experian, and TransUnion, do you think they're all going to give you the same credit score? No, they don't. It's never the same. They're always between these three companies, and then also I do know Credit Karma. I do know a little bit about Credit Karma. I did not know they allowed you like unlimited checks. That's really cool. That's really helpful. But everybody's going to be, within not 20 to 30 points, but I mean, it can range from, around 50 points for each of these. They're all going to have different scores for you. So like it says on that bottom point, lenders obtain a tri-merge credit report, and they will use that middle score. I mean, and if you were to just check these singly, obviously, I mean, you want to check multiple sites because, somebody could, if they did take your identity, they could be, reporting to TransUnion, but not Experian. And if you're only checking Experian, well, then your credit score could still be 700. But with TransUnion, somebody's taken out, $200,000 of debt, and your credit score is like a 3.8. So you just want to be careful for that. I would recommend you do an annual report, and you, like Vita said, I mean, if Credit Karma offers multiple, I mean, why not every 6 months at that point? Just you want to continuously be checking that because credit score is a big thing in securing a loan, like we've talked about hundreds of times in this class. We're going to go, that'll take us into talking about credit scoring. We're going to talk about what credit score do you need. And these kind of qualifying standards. So I thought this video was very beneficial even for me. I hadn't seen it before. I thought it was a really good video, so we'll go ahead and watch it.
Let's go from ProudMoney.com. What credit score do you need to qualify for a mortgage? That's what we're going to talk about in this video. But before we do, I'm going to ask you to please subscribe to this YouTube channel if you have not already. And if you have already, I thank you for doing so. So what credit score do you need to qualify for a mortgage? We will talk about the numbers, but I also want to say right up front that your credit score is most certainly not the only factor that is going to come into play when you're trying to qualify for a mortgage. So we'll talk numbers, but then we'll also talk about the other considerations that are probably just as important as what your credit score is. All right, so we're going to talk about the two main types of mortgages here when we talk about the credit scores that you might need to qualify. There's conventional mortgages and there are FHA or Federal Housing Administration mortgages. We're going to talk about the conventional mortgages first. These are the mortgages that come from banks or other mortgage lenders that do not have any backing from the federal government. So the money that they are lending out to you, they are taking a bigger risk with. There's no insurance that is going to help them if you don't pay it back. So they are going to require a higher credit score. So for conventional loans, generally the bottom of the credit score scale that you would have to get to in order to potentially qualify would be a 620 credit score. Now, obviously, you would rather be higher than that. 620 is going to, maybe just be the price of entry to get you in, but you're probably going to end up with higher interest rates than you would if you had a higher credit score, and even your chances of qualifying will be worse than if you had a higher credit score. But 620 is generally the bottom place that you need to get to in order to potentially qualify for a conventional mortgage loan. Now, if you can get to 720, that is generally thought of as the place where you are going to get the best rates from most lenders. Now, sometimes they'll be a little bit higher. 760 sometimes is seen as the place to get the very best rates, but 720 oftentimes is good enough. And if you can get to 760, that will get you, pretty much anything in terms of the best rates. Beyond 760 really isn't going to do a whole lot more for you. But 620 to get in, 720 for mostly the best rates, 760 is probably a guarantee of the best rates from just about any lender. Now, when I give you those numbers talking about credit scores for mortgages, you should know that the credit scores that are used for mortgages are slightly different than what you might think of as a credit score oftentimes. So if you are getting free credit scores from Credit Karma or a free FICO score from your credit card, those are sort of the general, usually FICO 8 or FICO 9 credit scores that are going to be a little bit higher than the FICO mortgage scores that are actually going to be used. So when we're talking about a 720 In mortgage scores, you probably most of the time would think of that as being more like a 730 or a 735 in terms of the sort of general FICO scores. And Vantage scores can vary from FICO scores as well. So probably what you want to be doing is thinking about FICO scores that are those mortgage scores. And if you're just sort of shorthand thinking about what your credit score is, you might want to take a few points off of that to think about what your mortgage score probably is. Now, you can actually get your mortgage scores from FICO directly. You can go to MyFICO, you can buy them. I actually did another video where I showed what you get from MyFICO, including those mortgage scores. Now, you might know that you have more than one credit score because there are 3 different major credit reporting agencies, and the credit scores that they have for you are all slightly different. So you're going to have a slightly different credit score from TransUnion to Equifax to Experian. So when you apply for a mortgage loan, the mortgage company is going to look at your application and they are going to pull all of your credit scores, all 3 of your mortgage credit scores from TransUnion, from Equifax, from Experian. They're going to get them usually in a single sort of document that is called a residential mortgage credit report. And what they are going to do is they are going to look at all of them, and they essentially are going to throw out the top score, they're going to throw out the bottom score, and that middle score is what they're going to use as sort of a shorthand for what your credit score is. So they don't average them out, they just take the middle one, and that is your credit score. Now, many people, when they're getting a mortgage, they're not necessarily getting that mortgage alone. So if you are getting a mortgage with someone else and you both plan to be on the mortgage deed and to have both of your incomes assessed and all of that as part of the mortgage process, well, then you obviously are going to have credit scores from 2 people. And the person who has the worst credit scores of the 2 of you, that's who they're going to go by. So if you, for example, have better credit scores than your husband, wife, whoever may be buying a house with you, if they have worse credit scores, it's going to be their middle credit score that is actually used. So you should know that in advance. So if you have a big disparity between the higher and the lower in terms of the 2 people that are going to be on all the financial documents, well, then you might want to consider actually having the person with the higher credit score be the only name on the documents, especially if that person can qualify for the mortgage based on their own financials, even without, the financial help that would come from the second person within that relationship. All right, so that's the deal with conventional mortgages and also the deal with how credit scores are used within the application process. Now let's talk about FHA loans. So FHA loans are loans that are still given by banks and mortgage companies and sort of traditional lenders, but they are loans that are insured against loss by the Federal Housing Administration, known as FHA. And because they are insured against loss, that means the standards to qualify are lower than they would be for the conventional mortgage loan. So for FHA mortgage loans, the credit score minimum is 580 in most cases if you put down at least 3.5% as a down payment on that loan. Now, there are FHA loans that go down to 500, but you have to put down at least a 10% down payment in order to get those, and not all lenders even want to deal with those. And even though those FHA loans are insured against loss by the government, the banks or other mortgage lenders still don't want to just give them out to anyone because they don't want to just insure against loss. They want to make a profit, right? So they're still going to do the general underwriting that they would do for anyone, even for a conventional loan, to see who is a greater risk than somebody else. So the whole FHA program was put into place to try to help people buy homes who maybe didn't have as much of a track record and didn't have as high of credit scores. But because the banks are still taking on a measure of risk, it's still their money being lent out, even if it's insured against loss, they do have some latitude to go outside of what the qualifications normally are for an FHA loan. So when I say 580 is the floor to get in, it usually is the floor, but it is possible that some lenders will give FHA loans, but that floor could be slightly higher. Now, while the FHA loan program is a nice thing for people that maybe have lower income and are looking to get into a more modest home with a more modest loan, you should also know that FHA loans have higher interest, and there are going to be mortgage insurance payments that come into play. So you're going to pay more for those loans than you would if you could qualify for a conventional mortgage loan. So even though you can get one of those loans with a lower credit score, if you can get yourself up past 620, or if even better, you get yourself up past 720, then you maybe could qualify for a conventional mortgage loan and you could get much better rates. Now, like I said at the beginning of this video, your credit score is not the be all end all when it comes to being approved for a mortgage loan. There are other things that come into play that are probably just as important. And those are going to include things like your job history, your income, your debt load, any bad stuff lurking on your credit reports. There's a lot of other things that a mortgage company is going to look at before they say yes. And one of the most important pieces is going to be your monthly debt to income ratio. And what that means is the amount of your fixed payments that you have to make every month compared to the gross income you make. So, for example, let's say you made $60,000 a year, which would mean you made $5,000 gross every month. Now, let's say you had this new mortgage and that was going to cost $1,500 a month, sort of all in with your mortgage. Let's say you had a $300 car payment and you had $200 of minimum payments on your credit cards. I'm oversimplifying here, but you put those things together and you would have $2,000 in fixed payments that you're going to have to make every month. So that $2,000 divided by that $5,000 in gross income for the month, that's before taxes, that's gross income. So $2,000 divided by $5,000, that is going to be a 40% debt to income ratio. And that is right on the borderline sort of where the mortgage companies would consider lending to you. So many cases they use 43% as that debt to income ratio. That is the maximum, although there are times when lenders will go a bit over that as well. However, for you, for most people, getting into the 40%, 43% debt to income ratio is pretty high. And it's not necessarily going to feel all that comfortable in your daily life to be up that high. So you definitely want to be lower if you can. So if you can get that debt to income ratio more down into the low 30s, that would really be ideal, because then you could pay your bills and feel like you have a level of comfort every month, not feel like you are just right on the edge of being able to keep all the balls in the air and pay for all the things that you need to. So those are probably the important things to know. The debt to income ratio, or DTI, and your credit score are obviously going to play a big part in whether you get approved. However, your mortgage lender is usually going to take a pretty deep dive on you. So if there are other things lurking in your credit report that they don't like the looks of, those could mean that your mortgage gets declined, even if your other numbers look okay. So one of those is going to be if you have late payments on your other loans, especially within the last year. Now, when I say late payments, I don't mean you paid 5 days late or you paid 7 days late because you forgot the due date and just, screwed up. I'm talking about if you paid 30 days late or 60 days late, long enough for the company that you owed money to actually put that on your credit report as a late payment. So a few days is not going to show up on your credit report. 30 days is going to show up on your credit report. So you want to make sure you don't have any of those late payments within that last year before you're going after that mortgage. Charge-offs, tax liens, anything on your credit report where you owe money and someone is still trying to collect that money from you, you may have to pay off that money to even qualify for the mortgage in many cases. And even if you don't absolutely have to pay it in order to qualify, many times you're going to want to try to do as much as you can to alleviate those things, whether it's paying off or it's coming to some agreement with the loan company, or maybe disputing things that are not true in order to get that mortgage to go through. If you have a foreclosure or a bankruptcy in your recent past, those could ding you from the start regardless of what your other numbers look like. Now, depending on the type of mortgage loan you're going after, the amount of time that needs to go by before you could potentially qualify could be different, but probably no lenders are going to look all that favorably on someone that has had either of those things happen in the last 5 years, and bankruptcies could go even longer. And in some cases, they have to go even longer before you could qualify for a new mortgage. There are obviously other things to know, and everyone's journey to get that mortgage finally approved is going to be slightly different depending on what you have going on your credit report. But those are the big things to know. Those are the numbers to try to shoot for in order to get yourself in a good place where things are squared away and you can increase your chances of being approved. If you have any questions or comments, please put them in the comments section below. Otherwise, I thank you for watching.
All right, so there's just a little bit more into credit scores and how they play a factor into the loan process. Now, qualifying income ratios. Yeah, this is very repetitive in everything we talk about, talking about the ratios that you can qualify with. They're going to look at the quality of income. Co-borrowers, you can, you and your wife, whoever else is signing on the mortgage on that note, they're going to, if Wyatt only makes, $4,000 a month, but his wife makes $10,000 a month, well, then they're going to take that combined amount, and you're going to have $14,000 a month in income that they're going to go off of. If you have any extra part-time jobs besides your full-time or whatever, they're going to take that into account. Alimony from a divorce and/or child support. These will also count as types of income, and you can report them for your loan. A lot of people ask, well, what about why child support? Like, I thought that was supposed to be solely for the child. They accept that because obviously it's going to be going towards a house and paying for a house, which will put a roof over those kids' heads. So that's why they allow it. And there's been cases where a mom has 5 or 6 kids with different fathers, and that she pulls in a pretty good amount of money each month because she has multiple kids all around the place. I've heard of situations like that where typically she wasn't making a whole lot of money, but she was pulling in a few
Get
thousand.
30% of their income for each baby daddy.
30%?
30% of their income. Mm-hmm.
That's insane. All right, so you could obviously, if you if you like people and you have a bunch of kids, then you can pull in quite a bit of money if you have custody of those kids. So something to think about.
I know people that made that their career, and I'm just like, you're ashamed.
Oh yeah,
You're
yeah.
almost.
I've known a couple people too. I didn't know it was 30% though.
It's 30% for each one, but if you have multiple kids with them, you still get only 30%. That's why they have different ones.
Oh yeah, so they just do one each, pop one out each, and one of the
Yep.
things.
Yep.
It's a grind out here. You gotta make your money somehow. So yeah, they take into child support into account as well. Percentage of your gross monthly income, not even your net income. Obviously, some people, tax brackets are gonna spike up here pretty soon, supposedly, for the ultra rich. But for conventional loans, your gross monthly income, your note amount can't exceed 28 to 36% of your gross monthly income. For FHA, 31, and then you see for VA, it's 41. But if a veteran, somebody who has is applied for a VA loan and they give them that 41%, can anyone give me a reason why you wouldn't want to, if that person qualifies for a $400,000 loan, can anybody guess why we would try to stay away from getting them a $400,000 house? Can anybody kind of give me any ideas why you wouldn't want?
I would say because if something in their life changes or they end up getting more debt for some reason, then they won't be able to afford it. So they would have to be able to sustain only the $400,000 loan.
Exactly. Yeah. So anytime you get anyone who kind of wants to hit their max in qualification, obviously as an agent you can't tell them no. You're going to go ahead and show, and you're going to help them along with that process. But you don't want to recommend if they let you know, hey, we qualify for up to, that $400,000, you're not going to want to go do a search on the MLS for houses that are, 350,000 to 400,000, because if like Vita said, if say they were to lose their job, or something unexpected happens medically, and they have those expenses, with them paying 41% of their gross monthly income, not even their net, that's around half of their income is going to be going to the mortgage or that note. So if they're depending on, at that point they are going to be depending on their paycheck to be able to pay that note. So you want to keep it, as low as possible, just to help them in the long run, just in case anything unforeseen happens. I've heard of situations where, people say, well, I'm not going to lose my job. I've been there 15 years. And, obviously they didn't, in that situation, they've never lost their job while I was with them. But I've heard of plenty of people, especially within the last year, who have been with companies for a long time and have put in the long hours and have raised the ranks. And, they do get cut. If you're, say you run a business, and I've been working there for 20 years, and I make, since I have been working there for 20 years, I make quite a bit. But Gio just got on. He works the same as me, the same job as I do. He's a good learner, quick learner, younger, in better health, and you pay him a lot less. If your business is struggling, who are you going to let go? Yeah, you're gonna let go of the older guy. And that's kind of what's happening, or what's been happening through COVID. Is they're letting the people go who have been there longer, because they are paying them more. So they want to pay the people who they pay less. That's who they want to keep on, because they are going to be younger. They're going to be there longer term. So if anybody says, oh, it's okay, I've been there for so long, like there's no way I get fired. You never really know. There's never really a guarantee in this world. So you want to stay away from those high loan percentages as much as possible. And then you see in those brackets down at the bottom, there's special loan programs that may use higher ratios. There are some programs that allow a little over 50% of their gross income to be available to pay towards that note. So, and if you're paying over 50% of your gross income, that means it's around, maybe in the 60% range of your net income, what you actually receive. And if you're just putting 60% into your note, and then 40% you're living off that other 40%, that's a very dangerous place to be. And if anything happens, it's going to put them in a hole really quick. So, like I said, if anybody ever comes up to you and says, "Oh, I qualify for $400,000, let's go look at $400,000 homes," just give them just give them that kind of quick little spill. You never know what's going to happen. Your duty is to look out for their best interests, not only right now, but in the long term. Obviously, you're going to want to show them that $400,000 house as compared to the $250,000 to $275,000 range, because that $400,000 house is around $12,000 in commission on your part once you hit that 3%, and everybody wants a $12,000 as compared to $6,500, $7,000. Obviously, you'd like to double that check, and it will be nice, but you want to look out for their. You're here to serve their best interest, not only now but in the long run. So just keep that in mind when you start to take on clients, because I have had clients who have qualified for a $475,000 loan, and right off the bat they started sending me like $450,000 homes, and so I had to kind of like talk with them and let them know, it's probably not in your best interest to do that. If you have the cash reserves to be able to pay, you have enough savings already, we can start looking into that. But it's just something you want to keep in mind. And kind of going back to that, the bank is a business. They're here to make money, and the bank is going to qualify them for the highest percentage possible. that they qualify for. So you want to keep that in mind as well. Like the bank is there to make money, so they're going to give them the highest amount possible, so they can make as much money off that interest. So just be aware of that. Talking about value here, value in use, value in exchange, and market value. Your market value and your assessed value in terms of taxes are not going to be the same. There's sometimes where you'll see a home on the MLS that's listed for $275,000, but the assessed value through the county appraisal district is in the $210,000 to $215,000 range. That's what the assessed value is, and that's because luckily we live in Texas, which is a confidentiality state, which means you don't have to report how much you pay for a house. You don't have to report that to the government. Talking about, if you were to buy a car, a used car off of somebody through Craigslist or whatever site you may choose, and you pay $10,000 for that car. Well, when you go to get that title transferred, how much are you going to tell the county, how much are you going to tell them that you paid for that car? Are you going to tell them you paid that $10,000? Heck no, you're going to say, oh, I paid $4,500 cash for that. Because like we said multiple times, the government, they love to take your money. They hate to give it back, but they love to take it. So, and anything you buy, car, house, it's all going to be taxed. So if you go in and you tell them, it's a cash deal, I bought this car for $4,500, well, they're going to hit you a tax for $4,500 instead of that $10,000 that you actually bought it for. Yeah. So, but in terms of houses, we don't have to disclose to the local government, the local appraisal district, how much we actually bought the house for. So when you go in to transfer that title, you're going to tell them, I bought that house for $0. I got it for free. I paid $1 for it. Obviously, they're not going to believe you. So what they're going to do is they're going to go to their the last value that they know the home was sold for, and they are going to give an their best estimation on that house. And so typically, what we run off of, this is a rough estimate. This isn't exact every time, but when you go through the CAD in any district, the appraised tax value is going to be about 70% to 75% of the actual value of the actual market value of the home. So, if you ever go and you see a house listed for $200,000, and then you go checking the CAD, looking at all the specifics, and then you see it's appraised at $200,000, you're going to want to tell your clients, hop on that. Like, if y'all want this house, buy it, because there's already equity in that home once they buy it. Because it really should be, marketed at around in the 250 range. So a lot of experienced agents know that, and if they ever see something that's assessed at the same price that it's listed at, then they're gonna try to get their clients to put in an offer as soon as possible if they want, because they'll obviously be able to turn that home over and run it for a profit once they sell it. So it's something that a lot of new agents don't really deal with. They don't really remember, but experienced agents like Justin, and he's pretty good about keeping us on top of things. And he reminds us often, if you see something that's assessed and listed at the same price, let your buyers know. Notify them and kind of run them down on the situation, because there's already equity built up in that home. So, talking about the appraisal, they run off the appraiser independence requirements. Those are their requirements to get licensed and to perform appraisals. They run it through the Uniform Standards of Professional Appraisal Practice, USPAP. Never really had to deal with that at all, but it's just something for you to know. As I said, I haven't said it today yet, so we're almost an hour in. I haven't said it. You don't have to know the specifics of all of this information. You're just here to know and learn the general idea of everything. So, you know, and talking about appraisals, you know, that why, in your opinion, do you think the appraised amount, once you hire an appraisal or an appraiser, and they go out and they give their guess on their opinion on the property's value, do you think that is what the home is actually worth? No, no, it's not. It's just that appraiser's opinion, personal opinion. You can have multiple appraisers come out. I actually had a client that wanted multiple appraisers because she didn't believe the property was. It came appraised a little under what she expected. She thought her property was worth a little more, so she had another appraiser come out, and that second appraiser actually went lower than the first one. So, you know, you're going to have, anytime you have an appraiser, it's not really the actual value of the home. It's just their best estimation. You know, what really is the value of the home is whatever the buyer is willing to pay for it. That's going to be what is the best estimation of what the home is worth, because they're obviously buying it and paying for it. So appraisals are never spot on. You're never going to say it's worth 250 and have every other appraiser come through and say it's worth 250 as well. That just doesn't happen. Obviously, appraisers are state licensed or certified. They have, you can go through, and I think it's just a few weeks as compared to a few months for a realtor, but you can go get your appraiser license. I mean, if you'd like to do that and you want to start doing appraisals, obviously you can't do appraisals for your own properties that you're either listing or buying for. That would be a very big conflict of interest, and you could be helping your own pocketbook in that manner. So, but if you have buddies who are agents, and you become an appraiser, well, you can appraise for their deals, and make extra cash on the side there. So there's a ton of ways in real estate, whether it be appraisers. We'll kind of talk about abstract tiles here in a minute. There's multiple ways in real estate to make money. You don't just have to be a real estate agent. So yeah, good thing to always keep in mind. Now, talking about the appraisal process and the sales comparison approach, you know, this is where, you know, not really talking about appraisers, because we use the same process as agents. We'll run a CMA, and what a CMA is we'll look, the property that we're trying to value, we'll look at properties within the area, 3 actives and 3 previously sold, that are all comparable. And you want to look at size of the property, size of the house itself, as in square footage, bedrooms, bathrooms, those types of specifications. Garage size is a big thing. So you're going to want to try to find 3 comparables that are active currently and that have already sold. And then from there, you'll just take your kind of best guess. I think it's a little bit better than this one, so maybe a little higher, a little worse than this one, so a little lower. And that's how you'll get, when you run a CMA on a property, that's how you'll get the value. Like I was talking about appraisals, you know, Justin will sometimes come into the office and he'll ask us agents, he'll say, hey, I want all of y'all to do a CMA on this property. So we'll all go through. So we'll all go through, we'll go find those 6 comparables, ones that have sold and ones that are active. And when you look at the ones that are sold, you want to do between 0 and 180 days. So in the past 3 months, if you have to go back 6 months to find something within the area, that's acceptable. But you don't want to go back much further than that, especially right now. Even if you were to go back, you know, 4 months from now, the prices are going to be way different. Prices have skyrocketed in this area and all throughout Texas in the past few months. So if you do a CMA right now, you're going to want to do, if you can, within the last month or so. And houses are selling so quick and so many people are putting them up on the market, it's going to be relatively easy to do that. So, and you don't typically, just another, you know, nothing that you'll need to know for your test, but just for future knowledge and doing CMAs, once you do receive your license, you don't want to go any further than about a half-mile out from that property. You want to stay within a half-mile radius and find those 3 solds and 3 actives to try to get your best approximation of value of that property. The cost and replacement approach. This is if the building or the property is very run down, in poor condition, or if it has been wiped from a hurricane or a fire, that kind of thing. You're going to take you're going to kind of see how much it would take to buy the property itself. You do a CMA on the land, and then an average value of the house that's built in that area, and that's how the appraisers appraise the value of a cost approach house. And then income capitalization approach, or gross rent multiplier. This is talking about, sorry, I just got a text from one of the other students in the class. But talking about that income capitalization, this is in referring to when somebody goes to sign on a house or goes to sell their house, what they're going to do is, if it's not, if it's more profitable, appraisals will look at all 3 of these, run all 3 of these on each property. And it's typically the sales comparison approach that's going to come out on top because they want to sell. But you could run into a situation where it's going to be more profitable for that owner if they don't need the money to move into their next place, or kind of a situation like that. It'd be more profitable instead of selling than it'd be more profitable to rent out. So they'll run that as well, and they'll give the seller those numbers along with the sales comparison approach and the cost approach. So, obviously, if you have the funds and you already have somewhere else to move in, it's great to be able to rent. That's continuous income that you really don't have to worry about. So they'll do that as well and kind of offer that up to the sellers. Now, qualifying the title. And talking about qualifying the title, constructive notice and actual notice. Constructive notice is where every week the county, or every month, the county will post on the bulletin board the number of homes that are being sold at a tax sale or those foreclosure sales through the county. And with them posting it up on that bulletin board, that's what we consider constructive notice. Because it is general knowledge to the public, although not everybody knows, but it's not private information to know. That information is on that bulletin board, so anybody can go check, look at that. And then, like Ms. Vita was saying, on the second Tuesday of every month, she said a couple days ago, the second Tuesday of every month is when those tax sales occur. So, I didn't know this beforehand, and I'm sure this is all news to the most of you, but typically there's 20 to 30 people a day that go and check those new tax sales that are going to go on at the beginning of the month. So it is specific knowledge that only very few people know about, but since it is public knowledge and anybody can go see it, that's what's considered constructive notice. Actual notice is if I were to walk up to Gio and say, hey Gio, you owe me $5,000 for whatever, me directly going and talking to you or handing you something in person, that's what we consider actual notice. So, and talking about abstract of title, abstract and opinion of title, this is, anybody can go do this. You can go look through the public records on properties and see, look through the title history on each property. And this is kind of where we talk about abstract of title. You can, that's another like 2-week course that you can go through and get your abstractor's license. And what you do is you go into the county's office, you go into the record rooms, and you search through a specific property, and you go through the history of title on that property, and You know, typically, if you were to do that job, they charge about $250 per hour to go and do that. So it is pretty lucrative if you can get business for it, and you know people to do that for. Obviously, you won't be able to write up the opinion. The opinion on that title will have to be written by an attorney. But you know, in being an abstractor, it's I mean, it's a difficult job. It's not easy. You go back, you search back 100 years on a property. You say, I mean, they'll give you the time limit that they want you to search. Obviously, if it's it's been passed down. This property's been passed down in the family for 15 generations, and you have to go back 300-400 years to go look at it. Then you're going to be charging a lot more than just in a regular residential area for a property that was built in 2015. That's generally going to be a pretty easy one. You'll be able to figure that out within an hour or so. But if you're having to look back hundreds of years on titles and go through the history on that, it's going to take you quite a bit of time because people will pass it down through wills and stuff, and especially back in the day when we didn't have title companies who did such fine searches through the title. There were times where it was given to two brothers, and one brother moved off halfway across the country, so the other assumed basically all of the land without actually signing that he owns it all. And then he sold it off, and it's been sold a couple more times since then. Well, the brother who moved away, technically, since he didn't sign off his portion of that land, he can come back and try to gain that land back because he has 50% ownership of it. And that's where we get down here to the cloud on title. That's what would be considered a cloud on title or a gap in title, somewhere where, or even that other brother who moved across the country passed away, but had 17 kids. Well, they're all entitled to 1/17 of that property, 1/17 of 50% of that property. So if a gap on title is found like that before you purchase, you will have to go through and try to get all 17 of those kids' signatures, writing off their ownership of that land. And obviously, it's pretty hard to do that because out of 17 kids, or even if it's 5, I've heard of situations with 5. Well, probably most likely 3 or 4 of them are going to be okay with just signing it away. I never had anything to do with it. I didn't even know it was there. Doesn't bother me at all. Go for it. But you're always going to run into 1 or 2 people that, well, shoot, I mean, if I'm entitled to a percentage of that, then I want to make some money off of it. So getting them to sign off, you'll have to come to settlements with them. So doing this abstracted title, it could be it's a very can be lucrative business, but also it's a lot of work. And then, but thankfully now, dealing in residential areas, especially in this area, title companies will do, for the most part, their own abstracted titles. So we leave that to the title company now because it's a lot of work to go through. I've seen their abstracted titles and the stuff they go through. It's a lot of legal documents that are hard to comprehend, hard to understand. So they pretty much do that now, and that's why they offer title insurance. And Gio, this is going to be a hard question, but do you remember who pays for the title insurance policy when going through a transaction? Do you remember? Either the seller or the buyer. Just give me your best guess.
Repeat the question one more time.
Which party on which side pays for the title insurance policy during a transaction?
The buyer.
Buyer. Okay, so I mean, there's a 50-50 shot. I know it's just a guess because that was from 2 classes ago. And I'm sure most of y'all, I don't even remember what I talked about yesterday. So I don't know how you remember something from 2 classes ago, but it's actually the seller. The seller will pay for that title insurance policy, and that's kind of giving them, kind of relief on their part, clearing title. Yeah, that's, I mean, it's something that you'll need to know going into the national and the Texas, like for your licensing exams, but that won't be in this finance test, so you don't have to worry about that. But yeah, title companies, that's why they offer title insurance to make sure that if anything, if you know, if you do have the title insurance policy, which is pretty much required nowadays, um, I've seen it in 100% of transactions. Everybody has a title insurance policy. Um, Title companies require if you work through them to get title insurance. And what this is, you know, if you were to have that situation where there's 17 kids somehow, you know, a couple title companies have missed it up to this point, but those 17 kids come back and some of them want their portion, well, that title insurance policy will cover the cost of that. And so you're not having to settle with those kids. That insurance policy is what covers it. So that's why they go through. They offer the title insurance policy, but that's also why they go through with the fine tooth nail comb. How do you even say it? I don't even know that saying. I've heard it. They go through it with a fine comb, and they make sure there is no cloud on title or gap in title. And if there is, they'll figure it all out before closing because they don't want to have to settle with those kids or those distant relatives who do still own part of that property. Talking about the torrent system, you'll receive a torrent certificate, and this is a document that assigns undoubted ownership to real property to the registered title holder. And this will hold, if you are to get a torrent certificate, it is the ultimate authority. You 100% own the land. Nobody can say or do anything that says otherwise. This isn't done a lot because we typically deal through title companies, which do title insurance. But this torrent system, if you run into somebody who has, you know, their torrent certificate, then and they're the seller, then you know that 100% no doubt that they own that property. Cloud on title, like we said earlier, is the same as that gap on title, something where it's a little cloudy on who owns the property or who didn't own the property, that kind of thing. And then survey, I think you all know what a survey is. We went over that quite a bit the other day, so no need to go into that anymore. Now talking about closing real estate loans, obviously the underwriter approves the loan. The underwriter is that person who we talked about at the beginning. They're the one who goes through everything, makes sure all your income, all that kind of stuff is 100% correct. They're the ones who, you know, look at it through a microscope, look at everything you have under a microscope and make sure you're good for the loan. The loan commitment, once it is written up, will be sent out to all parties that are involved in the transaction. You know, and once that's sent out, and you'll get a call from the lender and say, you know, they'll say, hey, why you're clear to close. Once you hear those 3 words, basically what you should hear in your head after that is just angels singing, because that means everything through the loan process is good, everything checked out, and you're clear to close, you're ready to go sign and get that property transferred, which means money. It means the check's coming your way. You know, when you hear clear to close, you'll hear this a few days before closing, typically a few days to a week before closing. And, you know, you always want to advise your sellers, you know, don't do anything stupid. Even if you are clear to close, they don't want to do anything stupid until after they've closed and the money has been funded. Because Justin was in a situation one time where he got the call, clear to close. He called his client, said, we're good to go, we're ready to rock and roll. This was the day before closing. And that day, he called him, I'm assuming sometime in the morning to early afternoon. And later that afternoon, that guy went out and bought his daughter a new car. And that next day, they got to closing, and they were like, your funds, your assets and liabilities, they kind of switched up, and the deal fell through because, you know, and he asked him, he's like, you know, what did you do? What happened? And he was like, well, I mean, all I did was co-sign on my daughter for her new car. Like, she's going to be making all the payments and everything. Well, any slight adjustment to that credit history or that credit report after if it hasn't been closed and funded yet, it can make that deal fall through. So always keep your clients. There's other clients who once they've been cleared, they're like, or before they go and apply for a loan, they'll want to go pay off all their credit card bills, pay off all their credit card debt with cash that they have, cash reserves are out of their bank account. You don't, even if they do have credit card debt, I don't recommend they do that because you're turning that asset that they have, that cash or that bank account, the money in that bank account, it's going from an asset to absolutely zero. Yes, it is taking down your liability amount, but your assets are obviously what the loan officers take into majority account. So you want to be careful once you get that clear to close call. Yes, that's exciting, but you still need to stay locked in and keep your borrower locked in and that buyer, because any slight change that they make to their credit report or anything they do financially, it can make the deal fall through. So the lender closing department prepares loan documents and establishes the escrow account. Talking about the escrow account, we do, as y'all learned in the last class, now all escrow, the option fee and the earnest money are kept in escrow by the title company. There are some situations where the seller can take on the option fee and the earnest money. Not here in Texas, we do it all through the title company. But there's states like Pennsylvania, the option money and the earnest money is kept through the selling broker, the listing broker. And that's, dangerous because, once there's a lot of paperwork that flies around this office, there's a lot of checks that fly around this office. If we had to keep up with any more option and earnest money, there's no telling, it could get lost. They could, report that we did something with the money, that it was stolen, or that we, there's all kinds of stuff that can happen with if it's kept at the brokers or anywhere else. So luckily, we do it with the title company, and a lot of people choose to do, instead of writing checks, they've started doing wire transfers or electronic transfers. So that kind of leaving it out of the agent's hands, out of the broker's hands, takes a lot of liability out of our liability out of our hands. So it's definitely nice to do that this way here. Documents are sent to the settlement agent. That's the closing officer to make sure everything's good. And the settlement agent will prepare the deed for transfer over. And this, we can go through this real quick. Western states, they settle in escrow. Middle and Eastern states settle with attorney or the title company. Like I said here, we close through title. Thankfully, it just makes it much easier. Attorney, obviously we don't have to deal with that, but that's just 2 points to keep in mind for the test. And then the HUD-1 settlement statement showing all charges and credits. This is given at closing. I don't know if y'all remember, but that was the paper that had the real estate's commission or the agent's commission up at the top, and made people pretty upset. So as you remember, it was changed to the closing disclosure in August of 2015. So now that's what's given out at closing. Yeah, that's pretty much all you need from that slide. Charges and requirements. The seller is meant to pay the broker commission. Now this is that full 6% that will be split up between the buyers and the seller's agent. Again, we can talk about the difficulties that you'll run into when talking about commissions. You can list the house, especially now you can list the house in 3 days of work. You sell a house and the selling agent will make, anywhere from, $6,000 to $12,000 off that 3 days of work. A lot of sellers are gonna be like, well, what the heck? I mean, you barely did any work. why am I paying you, this amount of money? That's again where you got to tell them, do you remember how many steps it takes for a typical real estate transaction? Do you remember? We talked about it. It was last week we talked about it. Yeah, how many steps it takes as a real estate agent? Do you remember, Jim? No. Does anybody online remember how many steps I said it took to complete a real estate transaction as an agent?
I was gonna say 8, so,
How many?
I want to say.
So it takes typically 180 steps.
Whoa.
As a real estate agent, you're going to go even before you meet the client. If you get a listing that you can go through, before you go meet that client, you're going to have your listing presentation ready for that specific property. You're going to run a CMA on that property, know an estimate of the value that it's worth. You're going to do multiple things before you actually go out there and meet your client for the first time. So, like I've said before, there's a lot of stuff that goes into practicing real estate that your clients won't see. They think it's just you type a few things in the computer, upload a few pictures, and that's all you do. Stick a sign in the yard, and that's all you do. That's not true at all. You're going to deal with a bunch of headaches, a lot of stuff, but obviously it's worth it in the end. And when you get that paycheck, it's a really, really good feeling. And it's an addictive feeling. Once you get that first paycheck, you're like, oh my gosh, I've closed on a property. It took me about 2 weeks from listing it to closing it, and I probably did around 20 to 30 hours worth of work in it, not including driving. So that probably added another probably 20 or so. But, working 40, 50 hours and then making a good sized check it's going to be worth it in the end. So, I mean, yes, it is a lot of money and they're going to have some questions, but there's a lot of stuff that goes into it when putting it up or as a buyer's agent. So, I was just talking about the broker commission there. Obviously, the seller will pay for the transfer tax and recording fees. The buyer will typically pays for the appraisal, the credit report, insurance, title insurance, and recording fees. Now, why does the buyer have to pay for the appraisal? Yeah.
Yes.
No. So if you remember, everything in the contract, everything is negotiable. Right now in the seller's market, I just got an email actually right before class that the sellers have decided that they are not going to allow an option period for this sale. So our option period goes down to 0. That means we don't have any days. We can still do inspections and all that, but we can't back out for any reason. Everything in the contract is negotiable. The seller can pay for title insurance and recording fees, and the buyer can pay for the transfer tax and the broker commission. You'll never hear a situation where the buyer pays for the broker's commission. They're not going to pay,
So then the seller automatically gets the earnest money no matter what.
If what happens?
If they say that they didn't like the inspection.
Well, yeah. So this is actually before they're accepting offers up until 5 o'clock today. And I got an email at 5:28 that all offers that they haven't even presented to the offers to the sellers yet. But the sellers decided today that they're not allowing an option period at all for this transaction. So, I mean, like I said, everything's negotiable. We're in a seller's market right now. So the last house we put an offer in on, there was 16 offers, and so the sellers can pretty much stipulate right now whatever they want. And if these sellers are stipulating that we have no days to back out, there's 0 option period. I'm actually going to I'll have a phone call with my client after we get done here and talk to him about it, because we might rescind that contract, because like I said yesterday, we wrote up the offer and we presented it, but neither me or the buyer has been out to that property yet. So, you're always going to run into headaches, to situations where you're like, oh, what the heck? But you just gotta, work through them and figure them out. So, but everything is negotiable. Nobody is required to pay for anything on either side. Either side can pay for it. It's all negotiable. Talking about prorations of the interest, taxes, insurance, and utilities. Who do you think pays for the proration? Who pays for the day of closing costs? The seller or the buyer? Who do you think pays for the insurance, the taxes, the interest on the loan of the house on the
I would
day
say
of
the buyer.
the buyer?
Mhm.
That's honestly what I thought. And going through, I honestly thought that as well, but it's actually the seller. It's because it's still at the beginning of that day. It's in their ownership. So it's at the beginning of each day, you know, that midnight, that's who's going to pay for it. So the day of closing will actually be paid by the seller. The day after closing, obviously, starts the buyer. So, you know, if you live in a house for 6 months, you sell it right after, what's the 6 month? June. You sell it right at the end of June, June 31st. Well, then the seller's going to pay for the interest, taxes, and insurance for the first 6 months of that year. And then the buyer's going to pay for the second 6 months. Pretty self-explanatory. We're going to go to this last little closing video here. Oh.
Fiber changed my life. My name is Drew, and I'm the face and son of Fox YouTube channel.
So,
Drew. But this is the last little video for today. You know, just a short little 8-minute one, and then we got a few more slides to go over, and then we'll be done. So,
you are wondering what happens at a real estate closing. Guess what? We're going to find out right now. Hey everybody, I'm Tiffany Weber. I'm North Carolina, a real estate attorney. And I'm going to talk to you today about what happens between when you sign the contract and when you actually close on the property. The closing itself is the culmination of weeks of hard work by all the parties involved, including you, the buyer or seller, depending on which party you are, both realtors, lenders, and the law firm. The very first thing that has to happen after you sign the contract is your attorney has to perform a title search. In North Carolina, attorneys represent buyers in a real estate closing, so we're going to make sure that we do a full history report on the property to make sure.
Okay, now this part doesn't pertain to us because remember, the title companies do the title search in abstract in Texas. So this part isn't important, but after I should have skipped through it. I'm sorry, I don't know where it is. So we'll just listen to it, but don't take this into account. We don't live in a state where the attorneys take care of the stuff.
There is nothing that can impede your ability to own that property free and clear. A title search can sometimes reveal that there are easements affecting the property. Perhaps the seller might have a lien or a judgment or bankruptcy affecting the property that has to be satisfied so that it doesn't affect the buyer. The title search will also prove that the seller actually owns the property, especially in cases of an estate. After the title search is done, there are a lot of things that have to happen all at once, whether it's by our law office, by your lender, or by your agent. So some of those things include you're likely going to need an appraisal if you're purchasing a home with a lender. They're going to want to make sure that the house is worth what they're actually going to lend you the money for. There's also going to need to be inspections on the property to make sure that the condition is good. That way you can ask your seller for repairs if necessary, and they can decide whether or not they'll complete those. Also, while all of this is going on, your lender is hard at work gathering all of the information from you necessary to make sure that you can get approved for the loan at the terms that you want. Also, our office recommends to every single buyer that you should get a survey on the property that you're buying. It's so important for a lot of reasons that I'll go into in other videos, but the main thing you need to know is that a survey is going to identify the boundaries of your property and make sure that there isn't anything as far as an easement or encroachments affecting the property that you should definitely know about. You would be surprised to hear the horror stories that can come about when you don't get a survey. I can't believe it, but this actually happened. I've seen a situation where a person was buying a property where the boundary line actually cut through the middle of the home. I know it's crazy, but it can happen, especially with family land and lack of surveys. So usually those things are simple fixes that require a couple extra pieces of paperwork, a couple extra filings, but it still has to be done, and all of that could have been prevented with a survey. While everything else is going on, we're at the law office preparing your closing documents. Now that's a long, thick stack of paperwork that you're going to have to sign at the closing table. And it includes a lot of official documents that will be recorded with the Register of Deeds to make sure that you gain official ownership of the property. your agent know so that we can get everything cleared up before the closing date. And once your lender gives us the clear to close, that means that you can come in and sign all the paperwork. So you're at the closing table. You're wondering, what am I going to sign? Well, it's a lot. And that's starting with, we're going to show you a plat or some sort of visual reference of the property to make sure that you're buying what you think you're buying. Again, another horror story that thankfully didn't happen in our office, but it's happened before where without a survey, someone bought a property that they thought was actually the property down the street, and they didn't know it until months later. So in our office, we always like to show you the property right there on a piece of paper and ask you, is this what you're meaning to buy? Next, we're going to go over the title work, which I mentioned earlier, is the history report on the property. So we'll call out anything that you should really be aware of, whether or not there are restrictions on the property that might affect what you want to do with it. For example, some neighborhoods you can't have chickens. If you really want chickens, that's not a good place for you to live. Also, we'll talk to you about whether there aren't restrictions on the property, what rules you do have to follow, because you still have to follow local zoning laws or the state laws of your town or state. So after we've talked to you about the title reports, we're going to go over the document known as your closing disclosure. Now you get this at the very, very beginning of the process, and it's called a loan estimate from your lender. So what your lender does is comes up with a really close guess of what your closing costs will be, what charges will be assessed to you at the closing related to you getting the loan. But because that can change over time, depending on what inspections you may need, whether you get a survey or not, then you have to get what is an updated closing disclosure right before the closing. Now, most of the time, people get that, see it in their email, disregard it. So that's why we spend time at the closing going over every page of that disclosure so you understand what your charges are related to the closing. So that includes what your down payment is, do you have any escrows? And escrows, that means that if your lender is going to pay your taxes and insurance, it'll come out of your monthly payment every month rather than you paying it separately. We'll talk to you about that too. We'll also talk to you about features of the loan, meaning do you have any weird terms that you should be aware of? Is it out of the ordinary? Does your rate fluctuate? Will you be paying the taxes and insurance yourself? Can you prepay? We'll talk about all of those things. And finally, we'll talk to you about how you can get in touch with everyone that was involved with the loan or with the closing, and that will also be included on your closing disclosure. Next, we're going to go through a series of affidavits or affirmations where you can tell us your marital status, because it is important in North Carolina what your marital status is, because it affects how you hold title to property. So we're going to affirm that with you, make sure that we've got everything correct on the deed. Speaking of how you hold title, meaning how you own the property, we're going to look at the deed with you and make sure that your name is spelled correctly, and also make sure that we have a good mailing address. This mailing address is where the tax office is going to send you your tax bill every year, just so you can be informed. During this process, we're going to have your seller affirm that there are no liens that can affect the property, meaning there's no one that's done work on the property that hasn't been paid. And we're also going to make sure that the seller affirms that if someone perhaps could claim a lien on the property and hasn't done so yet, that they'll make sure they handle it for you. After this part, your seller is usually done with the process, and everything left is for the buyer to sign. And first up is your promise to pay the money back. Yes, you have to. That is done by using the note. So the promissory note is where it lays out the terms of your loan, such as when you begin to repay the money, at what rate, and if you default, what the percentage points might be that you have to pay as a penalty. Following that, you're going to sign your deed of trust. And that's the instrument that gives your lender its security interest in the property, which is a really fancy way of saying if you don't pay, you don't stay. After you've done those two very important legal documents, we'll move on to the other documents that your lender wants you to sign. Usually that includes your loan application, where you affirm that you haven't quit your job since you applied for the loan, and that your income hasn't changed substantially. You didn't run off and buy a bunch of furniture or appliances or anything. Next, we'll look at your amortization schedule, which shows you how principal and interest is applied to the loan over time. So which portion of your payments actually goes to paying down the loan. Depending on your lender, there can be several more documents that you sign that affirm your tax identification number, or if you have an FHA or a VA loan, then you're going to have other documents specific to the program that you're using. I know this is a lot of information, but every closing is different. So this is a general idea of what you can expect.
All right, yeah, so that just goes a little bit into the closing process and kind of how it works. It's the same in Texas as it is in North Carolina. That obviously your marital status plays a big part in ownership of the property. So they'll check that here too. Now talking about servicing the loan, responsibilities. Principal and interest will be collected. Taxes and insurance will be collected and paid out by the title company. Also, their assignment, loans can be sold to the secondary market, like we've talked about. Originator retains servicing for fee, collection for late payments, and they'll also notify the borrowers when loans sold with loan transfer disclosure statement. So, that's a pretty boring slide, and that's gonna finish us up for the day. Everybody celebrate. Ms. V, you have to say something?
Yes, I do. So earlier you were talking about the who pays the taxes, and you said it was prorated. So is the seller paying half and the buyer's paying the other half of the year? Like I think it's divided, like you pay once in the beginning of the year and once in the middle of the year.
Yes. Yeah. Well, so they'll that's like the title company will do all that and send it all out. But yes, I mean, you pay taxes at the end of the year. So they will send, I mean, if you pay, you move out like right at that, June 30th or 31st, whenever that is. So you move right at that 6-month mark. At the end of the year, the sellers will receive a bill for the first 6 months on that property, and the buyers will receive a bill for the second 6 months. Everything.
Okay. Sorry, hold on. Sorry, go ahead.
Everything will be prorated to that day of closing.
Get over there. I'm so sorry.
That's fine. She sounds like she's having a great time, unlike the rest of us. So
She's having a lot more fun than the rest of us.
Yeah. But yeah, everything will be prorated up until that day of closing. So the sellers will pay for everything for that year up until that day of closing. And then everything after that, the buyers will pay for it. And that's all sent out through title and everything. They'll contact the county. And I mean, they're not going to miss out on their money. So it's not like you have to go and make sure, like, hey, I got to get my stuff for, the first, even if you were in there, you closed, at the end of January. You don't have to go, hey, I probably have to pay some stuff for January because I moved. They'll get it to you. They'll always find a way to get it to you and get your money. So.
Oh, okay.
Your question
Gotcha.
is expense or?
Yeah, because I was confused. I was like, why would somebody pay 6 months worth of taxes if like they were going to move out in February or something like that?
Yeah, no, it's only prorated up until that day of closing. I just used the 6 month as an example.
Gotcha. Okay.
Yeah. So, so that's, that's going to